Hi, this is Jay Hummel. Welcome to the Deep Dive, a show trying to help firms grow their revenue, their margins, and impact their clients in a more meaningful way. We're excited to be in partnership with Investopedia, Investopedia.com, to do the show. And I can't think of a more relevant topic in today's marketplace than cybersecurity, cyber risk for clients. And can't imagine that Mark Hurley would take the time to join us. Mark, CEO of DPP. Mark, thank you so much for spending time with us today. And I know most of the viewers of this show are going to know who you are, but just give people a little bit of background on you and what you're doing with your firm.
Thank you. Appreciate the opportunity to be here. I've been working with various companies in the wealth management industry for the last 25 years. Earlier, had a mutual fund company called Undiscovered Managers that was sold to JP Morgan. Had a company that invested in wealth management firms called Fiduciary Network. And then 3 years ago, we started my current company, which is Digital Privacy and Protection, which provides a turnkey cyber protection service for the clients of wealth managers. Costs about $35 a month, takes care of everything, is all inclusive. That's our service. We're working with many wealth managers right now and their clients.
Well, at the macro level, obviously the SEC mandates are coming later this year, changing the way that RIA wealth management, asset managers need to think about cybersecurity. You obviously created your company to be a part of helping firms deal with that mandate. Can you just give the viewers a little high level? You and I could talk about this for 2 hours, but we don't have 2 hours. Talk a little bit about the new mandate and how you're helping firms comply with it.
Well, yes. I think most firms are unaware of just how sweeping the changes that are being imposed upon them by the SEC. New rules were proposed in April of 2022, and last year they extended the comment period for them, and they should be finalized fairly shortly. I mean, they were expected to be finalized November or December of last year. As I understand it, the rumor is there's some conflict between the rules that affect brokers versus the ones that affect RIAs, and consequently, they're trying to work out some of those differences between different divisions of the SEC, and that's what's holding it up. But I would be surprised if there's
Surprise, right?
Yeah, I'd be surprised if they're not finalized very soon. Now,
Yeah.
the way to think about this, if I run a wealth management firm, is that this puts me fundamentally at the center of the issue of cybersecurity. They've equated having good cybersecurity, or adequate as they call it, with meeting your fiduciary duties. And under the new rules, assuming they get finalized in their current form, if you get breached, you're going to have to self-report within 48 hours. Additionally, you're going to have to make a series of disclosures to clients. And those disclosures include the fact that if the custodial accounts of your clients get breached, the clients aren't getting their money back. And most clients are going to be stunned to learn this. And what it is the SEC is requiring you disclose cyber counterparty risks involved in your service. And in order to use your service, you have to have a custodian. And every custodian, if they have any sense of self-preservation, they make these agreements breathtakingly one-sided because most people use very poor cybersecurity. Now, the other thing I would say is, when I talk about this topic, oftentimes people will say, I just really don't want to get involved in my client's cybersecurity and this and that. This is like a ham and egg breakfast. Bad news is you're the pig. You are involved. Right now, the way cyber criminals target wealth management firms is to either hack into the client's email or something else, their social media accounts, things like that. And they'll pose as the client, and there are numerous fraudulent transactions for millions of dollars have already occurred, or they'll go directly after employees. And so if I'm a wealth manager CEO right now, what I should be waking up to is the fact that I am now in the personal cybersecurity business. Yes, cyber criminals will try to attack my firm and their systems directly, but the most likely way they'll get in is going after my employees working remotely. 82% of all cybersecurity breaches involving financial services companies involve people working remotely. And the other way they're going to do is go after my clients. So now, as a wealth management firm, I have a compelling interest to, one, get my employees to use better personal cybersecurity, and two, to try to get my clients to do this. And if I can't get my clients to do this, I have to have a set of protocols to protect me, because I don't really know whether I'm actually talking to my client whenever we're communicating with them. It could be somebody in the middle and I'm responsible for making sure something bad doesn't happen.
Well, and the reason I was so excited to have you on the show when you called me on when you started the company is I think this is one of those rare opportunities for what you're doing in the space, which is you're protecting the end client, which protects the firm. And you're allowing an advisor to bring your kind of service to the end client in a value added way, which is it's very rare that you can be an advisor and bring something to the end client and also help yourself. Is that the way? Am I oversimplifying that?
We like to think that's correct. I mean, let's our service the client pays for. It's $35 a month. It's rounding error for most clients, and it's
Yeah.
turnkey, and it's designed to be somewhat analogous to providing tax advice. Very few wealth management firms actually do tax returns, but almost all of them review them. And they give
Hmm.
then after review them, they give the client tax advice. But it's a 15, 20-minute exercise every year. We've set it up to
That's
be the
right.
same way that we take care of everything, but we provide a report to the advisor that they review with the client, takes about 10 minutes, and then some questions. And based on those questions, then we update the client's protection.
Yeah, I mean it's an amazing service. I'm going to pivot, Mark, just because of your brain in the industry. You've always been early. You obviously released a paper a few months ago. You're obviously going to release a new paper, from my understanding, on this cyber issue. But you released a paper recently on just kind of the macro trends of what's going on in the RIA space as it relates to private equity, sovereign wealth funds, what's happening. Most of the viewers of this are owners of RIAs or home office leaders. Maybe just summarize your view on where you think the multiples are going, what's going on in the RIA space, and if you were a 58-year-old advisor, what would you be doing today?
First off, this paper is a continuation of some other papers I've written in the past. The earliest one, back from 1999, was about as well received in the industry as a discussion of botulism at a potluck dinner. Uh,
Yeah. I,
Loosely
I remember
translated,
when I
it's
remember when you and I first met. I was a little more crass. I said I felt like it was a turd in a punch bowl. Was what I
yeah,
what I referred to.
yeah.
So,
Loosely translated, it was look, the same forces that affect every other industry is going to affect your industry. You can do very well. There's incredible opportunity, but you actually have to run a better business and work a lot harder. And if you do, you can create a lot of value, and capital is going to be involved. And a lot of things that we forecast came to pass. May have taken some take a little longer than expected, but they came to pass. So we did a paper that's an update to that paper that looks forward. And the way to think of it is we just got done with one of the greatest parties in history. This was the 2012 to 2021 period where, on average, a diversified portfolio generated about a 10% after inflation return. And wealth management firms are the equivalent of operationally leveraged investments in the financial services markets. I mean, the financial
yeah,
markets. And so if the market goes up 10%, your costs don't go up with it. If you're operating, say, at 50% gross margins, your EBITDA just went up 20%. Well, imagine if that
yeah,
happened every year for 10 years. That's what happened. And so as a consequence, all the rules were suspended. I mean, most firms saw their EBITDA for turning their lights on going up 15 to 20% a year. And what we think, now is okay, that was great. Things were fabulous. There was a flood of cheap money because the Fed kept printing money and M&A prices went to the moon. I know of many deals that went off at 30 times EBITDA. What's
yeah,
happening now going forward? Well, we're in a different world. First off, organic growth is the most important thing. That's what builds value. It always has. But before there was financial engineering, M&A. Now there's 100 buyers. There's no arbitrage left. Market's ferociously efficient. What we think is going to happen going forward, number one, there's still going to be a big demand to buy firms. We think the buyers are going to be a little more careful on what they buy because before what they were doing is effectively betting on a rising tide. They would,
yeah,
borrow as much money as they could, buy a firm. Who cares you play a high price? If the market keeps going up, you make a lot of money.
yeah.
And it was a
You're
good
going to
bet.
outgrow it. Yeah,
Unless that comes back, which you never know. If I could predict the financial markets, I'd be infinitely wealthy. But unless that comes back, let's be clear, it's going to be a very different world. Now, good firms are still going to trade for a full price. I think the historical 8 to 12 is gone. I think if you're running a really good business, you could expect 17 to 20 times EBITDA. When I say a
I
really
agree
good
with you.
business, you're talking at least 2-3 billion of assets, and you've got a good bench, et
Yeah,
cetera.
greater than 10. What I've seen is greater than 3 billion, greater than a 10% organic growth rate on a percentage basis. Those things are still getting those kinds of multiples. But
Absolutely.
the five, six, $700 million firm who just woke up in the morning and the market went up, they're not getting those kinds of multiples anymore.
We're in a different world. Quality is actually going to matter. And really smart buyers are going to be more discriminating, but they're also going to have a value proposition that goes beyond price because,
Mm-hmm.
price always matters. Don't kid yourself. But what you're going to have is the smartest guys are going to say, look, we'll pay a full price, but also look at all the things we'll do to help you be successful post acquisition, particularly when a lot of the remuneration comes post acquisition. Second thing is the sellers are going to get a lot smarter. I mean, bankers have gotten a free pass. They're like glorified auctioneers getting paid millions of dollars to make a few introductions, get some proposals, and then tell you which one to take. What's going to happen going forward is if you're a
Mostly
banker,
based on price. Mostly based on price. So,
based on, and what you're going to have
yeah.
instead is bankers are going to have to build relationships with these firms way, way in advance to coming to market and educate them. So when they come to market, they actually know who the buyers are, what their concerns are, and they can prepare their firms well in advance of coming to the market to address all of these concerns.
The opinion you had, Mark, which I thought was really interesting, was the impact of sovereign wealth funds in the space. Maybe talk to the viewers about that a little bit, because I thought I've seen that from some of the deals we're looking at. I thought it was a very interesting point.
Think of if you're a sovereign wealth fund, and remember, sovereign wealth funds would include, someone like Michael Dell. I mean, let's be clear, he's
Right.
wealthier than most
Yeah.
sovereign wealth funds.
Right.
But your challenge is not making money; it's finding places to put money to invest for the long term to build intergenerational wealth.
Mm-hmm.
And incredible asset would be a very, very large wealth management firm. The industry is still growing. There are 7 million more Americans between the ages of 45 and 60 than there are 60 to 75. In other words, the number of clients in this industry are going to more than double over the next 15 years. So it's a
Yep.
great growth industry, but it's stable. And if you're really focused on not what you make in the short term, the long term, you can build tremendous value. That said, any wealth manager says, well, I wouldn't feel comfortable with a sovereign fund investing in me, then don't take private equity money. Because where do you think the private equity guys get their money from?
That's right.
In fact, most cases, the way the deals are set up with the sovereign funds is they'll say, we'll give you, say, $500 million into your fund. But in exchange for that, we'll get co-investment rights with no fees for, say, $1 billion. So when you actually,
Yeah.
you may not realize this, but if they've put, $100 million in your firm, part of it's come from a sovereign fund through the PE firm, and part of it may already be coming directly from the sovereign fund. They just don't know it.
They just don't know it. Yeah, I couldn't agree more. Well, Mark, we're unfortunately out of time. I hope you're willing to come on the show again in the future. How do people find you? I think what you're doing in the cybersecurity space is immensely important for people to pay attention to. If people want to do business with you, how do they find you?
My email is mark.hurley@digpp.com. Additionally, our website is www.d.pripro.com.
Man, that's awesome. Well, Mark, thanks again for being here. Really appreciate it. And I know you got a million things to do, and hopefully you'll do me a favor and come on again in the future.
Great. Thank you very much for having me.
Well, thank you so much for watching today. Thanks again to Investopedia for partnering with us on the deep dive. Visit investopedia.com, and we're looking forward to seeing you next time on the deep dive.